Ayon Mukhopadhyay, the Director Europe and UK of IIFL Institutional Equities. Ayon, hi, good afternoon and thank you so much for coming on board. Now, let me start with asking you about the global trade setup that we currently are made. Of course, wherever we look, all around us, there is a lot of uncertainty, a lot of concerns on the downside, whether it's Europe, whether it's Brexit, the China slowdown, or what is happening in the United States. There are increasing concerns of economic slowdown. There's increasing uncertainty about how the Brexit deal is likely to, sort of play out. But in an environment like this, how should one actually think of an investing strategy in an emerging market as India?
Good afternoon, everyone. Well, the thing is, yes, there is incredible volatility in the international markets, as you've correctly pointed out. But let me address each market, as you have said. In the US, for example, the scenario has changed quite dramatically, and the markets in the US, if you see the performance of the US markets, that's quite reflective of that. So you can see that I wouldn't say the Fed has done a complete U-turn, but the comments of the Fed, basically the concerns that were on the Fed, getting into a tightening phase, that has gone down. At least that we are in a position now where they might be in a sort of a pause, and maybe towards the end of this year or towards the beginning of next year, you could see a slightly, a cycle where they might even start being more dovish than they have been, or that the comments have been. And in that case, you would probably see an environment where you would see the US dollar weakening, and there was a major concern for all emerging markets, as you know, last year was a strengthening US dollar, and of course the strengthening of the rising of the US bond yields, which also has reversed. So I think that is incrementally the biggest positive for the emerging markets, that if you are in a scenario where the US bond yield is going to cool off with a dovish Fed and also with the US dollar being slightly weaker than what it has been, and you would see flows coming back with a bit of a reverse trend that we have seen from a DM to an EM sort of a way. And now coming to Europe, the thing is much more messier with Brexit. I am based out of London, and I think it's a very, very uncertain scenario going out with Brexit right there. I personally do not feel that a no-deal Brexit can be achieved. Politically, it cannot be achieved, and it will be a complete disaster for the UK economy, and even for the larger European Union. And I feel that could be a short-term, a panic situation in global markets. But the time is less, and I do hope that maybe it would be basically that kicking the can down the road with the Brexit arguments, and maybe 1 or 2 years down the line, a solution on that front could be reached among Brexit. And also, but trade wars still remain, and whenever we see some concerns regarding the trade war, things come across, they pop up, and the markets react in a certain way. But again, just to summarize, I think the biggest positive that's come out of the last 3 months has been the change in the stance of the Fed, and the concern that was there that you could have a hawkish Fed has actually gone away there. And now coming to India, I think from the FII flows point of view, I do not think we would see much of a flow coming in before the elections, because it's a very major event. So a lot of the FIIs would be fence sitters and would like to see how the government is formed post the elections in May, and based on that maybe would position their portfolio strategy. If there is a favorable outcome as to what they would predict, and if there is a continuation of the reform agenda, or if there's a strong government at the center, I think you would see a huge amount of flows coming in. But till that point of view, I think the markets would remain pretty much range bound in India.
Okay, that's right. Like you said, FIIs are likely to have a wait and watch approach with the right ahead of the elections. But whichever way, the elections turn, what historic figures show us that the markets mostly have, not mostly, but always have shut shop with a gain for the year for any election year that has been so far. So given that, historically markets have been doing well in an election year, why is there this cautiousness or this wait and watch sort of an approach right now?
Well, because the thing is simply because you do not know what will be the volatility going into the elections or on the day of the elections, right? So maybe yes, you're right. At the end of the year, you could have that scenario that you rightly said, but you don't want to be in a scenario where you could get the market even cheaper, or you could have some have some positivity around it. So it is an uncertainty. It is an uncertainty, and we just cannot look at historical anecdotal data. And end of the day, what drives the market is not a political uncertainty or a political agenda. It's basically earnings, and we have been waiting for this earnings recovery to happen for the last 5 years, and we have not really seen a pickup in the earnings. In fact, that's what makes I think that's what makes the Indian market look optically much more expensive and much more expensive than other emerging markets. So I think what would be the real driving factor would be to see what would be the reforms agenda going forward, and if the earnings the earnings estimates that the analyst community has been predicting for FY20 can actually come in, or even 2 years down the line can actually come in, because we have not really seen the earnings momentum pick up. So I think so yes, you're right. Anecdotally, maybe this is not really needed to have a wait and watch policy, but as an investor, this is not an event that you can ignore.
Okay, so yes, we'll I guess have to make peace with the fact that volatility is going to be the name of the game for some time now, and that jitteriness from FII side will persist. But if you look at the macros, last year we you just highlighted how dollar strengthened a fair bit. There was a rise in the US bond as well. Crude oil prices were had a huge impact on markets all over the world. But are those concerns now almost gone?
Yes, I would say the crude concern is completely gone from at least on the Indian market point of view. The crude concern is gone, and given even the dollar strengthening concern has gone away. You can see the bond yields have already cooled down in the US. And as I said, the Fed's comments have cooled down the markets. I think from the US market's point of view, I think the concerns would be more on the trade war front and also on the political front in the country. But I think from the Fed point of view and the crude point of view, I think that concern has been eased away. And I think the concern more would be on the European side, as you said, with Brexit, and of course on the trade war. And overall in the world, if you see with China cutting rates, with Japan cutting rates, I think overall I think there is again this feeling coming of money being eased into the system, and a whole liquidity crunch situation going away. So in that way, I think some concerns have been eased in that way. But I think the trade wars still remain a bit of a concern for the markets, and that could. But overall, I think if from 6 months to now, I think the mood has changed, and money would start to flow back into emerging markets from developed markets.
That's always been the hope. Ayon, great chatting with you. Thank you so much for